Hello, everyone. Welcome to our live today. My name is Belinda, and I'm joined with our esteemed guest, Sir Tom. It's the second time that he's joining our live, so we really appreciate having you back. So if it's your first time here, this channel is focused on academia, career, and lifestyle. So without further ado, just to introduce Tom for those who didn't join our live last time, he is an esteemed financial services professional with over 3 decades of work experience. He's one of those decades he worked as a chief executive for 2 listed insurance companies, and currently he is the chairman of Mayfair. So just handing over to you, Sir Tom, just to give some opening remarks and we can get started.
Thank you, Belinda, and welcome everyone. It's my pleasure to be here this evening, and I look forward to a very interactive evening. Most welcome.
So if you'd like to find out more information about his career journey, his academic journey, we went into a lot of detail in our past live. So I'll put a link once we're done with this live and you can go and watch that video. It was very useful. He gave a lot of wisdom in terms of navigating through your career journey, also things like work-life balance, and career choice, switching employers. So it's quite useful, and I'll put a link so that you can get to see that if you didn't join us last time. So today, our topic for today is investing basics. So if you're interested in building your investment portfolio, you're in the right place. If you can raise your questions as we go along, we're going to walk through 3 main categories, just starting off with how to get started, building your investment portfolio, and lastly, pensions. So raise your questions as we go along, and we'll cover them as we go through the different categories. I'm joining from Birmingham, and Sir Tom, where are you joining from?
I'm joining from the capital city of Kenya, Nairobi.
So definitely tell us where you're joining from. Let's kickstart this conversation with knowing our audience. Tell us where you're joining from and how your evening has been. So we'll now get through the different categories. So Sir Tom, just on getting started, it would be useful to know what your first investment was and when did you make it?
So I started investing when I started working, uh, basically because in my days we did not get enough pocket money to spare some for investing. So those that can start from pocket money from their parents should start then. But for most of us, I reckon it will be after we start working. So my first investment was opening a savings account, which was not a very good investment, as we all know now, because an investment needs to beat inflation. Yeah, because if it's not beating the rate of inflation, it's not a good investment. I then started buying shares on the stock exchange, actually by accident, because I was on an audit team where one of the audit members started talking about investments they were making on the stock exchange. Barclays Bank in Kenya was hot back then, so I bought a few shares. That's how I started. And then obviously, and this will probably make sense to a lot of our viewers from Africa, I joined a savings scheme, a SACCO, which is not mainstream investment, but as we go along, I'll probably point out some of the benefits of joining a SACCO. So, Belinda, that's how I started.
And you did mention, just as you were mentioning how you got started, that it was a bit tough at first to get started with investing because of other financial commitments. So, would you say that you need some sort of financial stability before getting started with your first investment?
Obviously, you cannot invest if you do not have some spare money after your expenses. There are some expenses you cannot avoid, rent, food, and so on. So I suppose the best way to look at it is that when you have an income or when you get an income, you need to apportion that income upfront to expenses and leave a portion for investment. Because if you don't do that actively, then you might find that you will take quite a bit of time before you invest. So Knowing what I know now, you shouldn't wait to accumulate an amount to invest. You should actually invest from the get-go by planning your income or salary for most people upfront.
Okay, that's well said. Thank you. So basically, start as soon as you can, and when you do start earning a regular income, dedicate a proportion of it to investments. And what percentage would you, from your own experience, what percentage would you recommend should go
Most
towards?
most people will find what I say as a lot, but I think 20% minimum of your gross income is what you should spare for investments along the way. What happens is that as you earn more and more, as you grow in your career, you will be able to spare more because, as you know, if you get a mortgage or a loan to make an investment, you can anticipate that up to a third of your income will go towards repaying the loan because we'll probably get time to talk about it. Not paying your loans on time is also negative investment, and one should also have a plan on how they pay for their loan. So minimum 20%, maybe start with 10% initially because your salary is not much. Quickly go to 20% within a year, but look to invest a lot more later on.
Perfect. Thank you for that. So I can see a few comments. So we have someone joining from Kenya. We have Lydia joining from Nairobi and Philippa joining from Accra, which is great. Definitely engage with us. We do have a lot more topics to go through. So if you do want us to cover some of your questions, raise them as we go along. We can also have a separate Q&A later on, but it would be better if you could raise your questions as we go through these different sections. I can see Edwin, who is also saying very good. Thanks, Edwin. And Janice, who's also joining from Kenya. Um, Perfect. So just going on with the topic on how to get started. So you have mentioned, if possible, someone to put down at least 20%. But if it's your first time, maybe start off with 10% and increase the proportion as we go along. So just as we're talking about this, how did you gain your knowledge on knowing what to invest? Because if you're putting aside 20%, you want to put it into a vehicle that is going to return as much as possible. So where did you get your knowledge on investments?
So I think some people will have a natural gift in investing, and if you have such people in your network, it's good to sort of have a chat with them or try and emulate them. But reading is also important because not many people know that you invest for certain reasons. Three broad reasons. I'll mention the books shortly. So you invest for an income, i.e., you set aside funds now, put them in some investment vehicle, start earning some income, regular or sporadic, as you go along. And the income needs to be higher than inflation because then you're not better off investing if you don't invest to get an income that's higher than inflation. The second reason you invest is to grow, capital growth, what is called capital growth. This is where your investment of 100 shillings grows in multiples over and above the income that I'm talking about. And if you're investing for capital growth, obviously the earlier you start and the longer you leave the investment, the better for you. You should also invest for security. The future is uncertain. That's why it's the future. So obviously, some of the assets you acquire over life or over your employment life or business life, you acquire some assets. You need to insure them to ensure that if anything happens on the asset or to the asset, whether it catches fire, if a car has an accident, for example, you're not set back to nursery school. You also invest against your life when you get dependents, so that you can safeguard your income if you're the main breadwinner, or even if you're not the breadwinner, it doesn't hurt to ensure that the foundation of your future dependence is guaranteed. And then obviously your youthfulness will feed your sunset years. So basically, when I say invest for security, you should also have pension in mind. And I'm happy that we are talking about that later. So what did I read to start off on the investment journey? There is a very simple book called Rich Dad, Poor Dad by Robert Kiyosaki. If you have not read that book, you're doing yourself injustice, and I strongly recommend it. It's written in very simple terms, but they make so much sense. Obviously, I have over time become a good or shrewd investor, and I still find lessons I learned from that book very useful. The second one that I read is The Millionaire Next Door. It's written by Thomas J. Stanley. It's by two professors, American professors, who studied millionaires in the US, and they have captured in this book a beautiful synopsis of how millionaires think and how they invest. So, The Millionaire Next Door by Thomas J. Stanley. As you get better with investments and as you grow older in your career, there's a book called How Much is Enough? Because obviously, investment earning can become an addiction to the detriment of the other aspects of your life. So it's important to read this book, How Much is Enough? It's by Robert Skibeski. Robert Skibeski. So there you go. Those are not the only books. You asked me which ones I have read. Those are
Mhm.
some of the ones I have read, and I strongly recommend them.
Okay, so those are the three books that you recommend. And on a day to day, so in addition to the books that you read, so those three, for example, that you've mentioned, on a day to day, what is it that you would recommend us to be checking or, reading? Maybe things like articles or certain magazines we should be following. Which ones would you recommend that have been helping you make useful investment decisions?
So most newspapers have investment columns. In Kenya, there is the Business Daily. There is the Financial Times in the UK. I'm sure there are various, investment specific or finance specific journals across the world. Um, Take interest in what is the rate of interest in your country. What's the rate of inflation in your country? Which sector in your economy contributes what to the GDP? Because as we discussed investing in shares later on, this is some of the information you need to determine where to invest your money. So, and you don't have to be an accountant, you don't have to have done finance at uni. You actually are paid in money terms irrespective of where you work. So it is important to invest in a bit of knowledge in money. But the one thing is, not all of us can be good at investing, even though all of us must invest. So this is why I said earlier on, if you have a friend who seems to be knowledgeable about certain aspects of investment, please feel free to consult them. But in most jurisdictions across the world, there is also financial advisors who are probably attached to banks, insurance companies, or even asset management companies that you can seek help from or assistance from. But investing in knowledge is important so that even as you discuss with your financial advisor, you can interpret some of what they're saying. And because at the end of the day, you should make the decision of where to invest, not your financial advisor and not your friend who is conversant with investments.
Thank you so much for that. So just checking some of the comments, we have Veronica who has joined us. And also there's actually a question here. Oh, I can see Martha who has also joined us from Kenya. So we have a lot of people from Kenya joining. Thanks for joining. I can see Edwin has asked a question around investment vehicles. That's literally the next category that we're going to go through. So we'll get to your question, Edwin. I can see Philippa has also asked a question. So this is related to what we've just spoken about. Maybe we can just cover it now. So she said, my first investment has been on my undergrad and professional courses, which takes over 50% of my salary. I'm hoping my certifications will get me better income and help diversify my income.
Yes,
Um,
correct. I talked about knowledge. You're not much good if you don't have knowledge. So, Philippa, I agree with you. Investing in your education improves the chances of you earning a big income in the future because you need an income to invest. Remember, that's what we said earlier. You
yeah,
need an income to invest. You can't invest air.
it's true. And it's you basically answered her next question, which was, "Am I on the right track? Any advice would be helpful." So, Philippa, Sir Thomas just mentioned you are on the right track. You do need an income to be able to even start investing. We have John who's joined us from London. Thanks for joining, John. So just moving on to our next segment, which is building an investment portfolio. So we've just covered now how to get started, some of the tips. So what would you say is the ideal investment type to start with for beginners?
All right. Before I get into that, let me appreciate my friends. I can see Veronica Lesser. I can see Edwin Otieno. Good people. Thank you and most welcome. So, investment income, I mean, vehicles. I said earlier that you invest for a reason. If you're investing for income, which is what beginners should do, is in the early days, there was treasury bills and treasury bonds and a savings account. Those are still there, but professionals have made that a lot easier for you. Yeah, because you nowadays can get what we call unit trusts, money markets. Basically, you're able to invest whatever you have, a much smaller amount, and command a significant return by way of interest income, because the asset managers aggregate the various funds contributions from various people and are able to get from banks decent returns, which you wouldn't as an individual, or you need a huge sum of money to get a similar return. So for beginners investing for income, most banks, most insurance companies, most fund managers will give you a vehicle called a unit trust, a money market, and you get decent returns if you're just looking for income. And the beauty is you have access to your money in a couple of days without losing interest. Because most fixed term deposits, you tend to lose interest. I mean, some income if you break a deposit midstream. Um, as you become familiar with investing, you should also now start investing for capital gain. And this is where shares come in. And as we said last time, you should invest in shares of companies that have a future, or companies that operate in a sector of your economy that is growing or that provides services that people require. In Kenya, for example, in Africa, telecommunication is a big thing. Banking is a big thing. So you hardly will go wrong if you invested in shares in a telecom company. In Kenya, it's Safaricom. In your country, it's BT and so on. Other countries, Vodafone and so on, if they are listed. You also cannot go wrong in most African countries if you invest in banking shares, in shares of listed banks. But you need a bank that is big. If you know where big companies bank, if you know where government banks, most likely those are stable, good banks. And if they are listed, you would not have any worries if you invested in those. So I am now talking about investing for capital growth. As your income increases, you should also consider investing in things like property, long-term assets like land. I know in Europe you don't understand what land means. You probably can buy an apartment
Yeah,
uh, or REITs. Do you have real estate unit trusts in your country? Perhaps it's
yeah.
the next best equivalent to land, but in Africa or in developing countries, buying land would be an area of capital growth. And the land needs to be in an area that is promising to have development or growth in terms of infrastructure down the line. Um, and all along, remember to invest for security as well. So as you grow your assets, insure them because disaster can strike and all your effort goes up in smoke. As you become financially astute, insure your life as well, because you're dependent. And you could also have an accident that interferes with your ability to get an income, and an appropriate insurance policy obviously replaces that income for you whilst you recover. So this is important. I don't know whether that answers your question, Belinda.
It does. So what I got from it, just hopefully I've captured everything. So I captured that basically when you're starting off, you probably want to invest in vehicles that are income. They give you income. So more like money market funds. And then as you become more stable, you start venturing into stock, so investing for capital gain. And I'm assuming when you're saying for capital gain, it means you shouldn't withdraw anytime soon. You want it to be a bit more long term. Actually, a question on that, just to clarify to everyone watching. Around how many years would you recommend if someone is buying shares for capital gain? Around how many years until they withdraw, or is it just for a lifetime until maybe when the company makes a fortune and you decide to sell at that point?
No,
And
the good thing with shares or stocks, as you're calling them, is that most pay dividends. So actually, when determining or deciding which shares to invest in, look for those that pay a dividend, so that you tick two boxes: the income, but
Mm,
also the capital growth. Uh, Basically, money markets is instant money. It's as good as cash. So put in your money market money that you need access to. And on average, we will be talking about a good investment portfolio later on. You should have in cash or near cash an amount that can sustain your monthly expenses for 6 months. That's ideally what you should go for. If you have cash and near cash that is more than your 6 months worth of investment, you're wasting an opportunity in the sense that the fact that it's money market, the fact that it's cash, you can only earn so much. You don't get, the risk is very low. So your the rate of earning is also low. For shares, as you asked, we're looking at about a minimum of a year in most cases. Probably a year to 3 years is what I would say, because what you find is that good companies will maximize the value of their shares in a certain time, and the share, even though the share will continue appreciating, not at the rate at which you will beat inflation, or put it this way, you will have other better shares that are growing faster than this one. So if a share is tending to maturity in quotes, because there's no such thing as mature shares, you need to look at another one where the sector is growing faster, so that you sell this after you've gained, and you invest in this faster growing area of the economy, hence shares in that represented in that sector. Does that make sense?
yes, it does. That's useful. So it's good to know that it shouldn't just stay in one company. It's good because they're all increasing and growing at different rates. So you want to move companies as we go along. Okay. So I'll just put Edwin's question now before we go to the portfolio, like a balanced portfolio, what that makes. So Edwin is asking, how can investors identify corn investment vehicles that pose as SACCOs or mortgage companies, especially when they're accommodated in mainstream media and get free space from government to operate?
Corn investments, if the return is out of this world, chances are, if the promised return is out of this world, chances are that it's a corn. Um, there's a phrase I'm accused of saying a lot, that we are not in heaven yet. If let's say money markets in your country are on average giving a return of 10%, but someone comes along and says, oh, you must invest in our unit trusts, the return is 18%. Everyone else is roughly around 10%. Be very cautious about the 18%. Um, and basically, and this is why I was saying that you need to invest in reading your business or financial columns in newspapers. Uh, there tends to be information on suspect ideas or suspect investments in those columns. But basically, is if not many people know about it, if the rate of return is too high, even for you as a novice investor, it sounds too high or too good, I would say think twice. In the investment of medium to long term things, what you want to be comfortable with is the how authentic. If it's a piece of land, invest a lot of time in checking out the title. If it's an unlisted company, a startup or a company that's not yet on the stock exchange, invest a lot of time in trying to find out the history of the people behind the company or the investment opportunity. Has anyone heard of them? What's Nowadays you have the internet. Google them, see if anything untoward comes up before you commit your hard-earned funds to such people or such ventures. In Africa at the moment, there's a lot of opportunities in quotes on foreign exchange trading. Um, I don't think you'll become a millionaire trading in those foreign exchange platforms, in the sense that I think they are skewed towards benefiting the owner of the platform. I'm not saying you can't make money there, but don't put money that you need on those FX opportunities. Most of them are disappointing people. I think while I'm at it, I could touch on bitcoins and cryptocurrencies. Uh, a lot of people have made good money in it, but as is often the case in investments, you make money because someone else has lost money. Um, you make money on the stock exchange because you bought shares at 100. Someone is coming in at 250, so you sell at 250, you make 150. The new buyer, in a way, has earned you that income. So for cryptocurrencies, I think you need to invest in a bit more info. And again, don't put your kids' school fees in cryptocurrency, is what I would say.
Thank you for that. So I'm seeing a comment here that your microphone is a bit low.
Oh, okay.
Um, if you could just comment and say if this is still the case, because I can still hear him very well. But just this was made around 10 minutes ago. So just let us know if you still can't hear Satom, and we'll do our best to
Okay.
try and resolve.
Some are saying they can hear me okay, so I'm not sure. Okay, I'll try and shout.
Yeah, maybe just increase your volume a bit. I can hear you very well, but of course, I can see around two people said that they couldn't hear you. I can see Priska joining from Zambia. Welcome, Priska. Polly is saying that this is great information. Perfect. And Broski is saying very insightful advice. And we have also FGC Kenya who are saying these are priceless tips. Thanks for that. So we'll then move on to our next question, still in this category of building investment portfolio. So you have mentioned what one should look for when they are trying to avoid corn investments. But now on the flip side, what should one look for? What do you usually check for? I think you hinted at it, but maybe if you could just clarify what you look for before you make an investment. What do you check in that company so that you have the highest chance of getting good returns?
So there's two things to look out for. In most stock exchanges publish the price of a stock over the last 12 months, the lowest it's been and the highest it's been. So it makes sense at the point you are considering investing in a share to look where in that spectrum the current price is. So let me give an example. If the lowest in the last 12 months has been 100 shillings and the highest has been 500 shillings, because the price of the shares, as you know, oscillate, and the current price is 499 shillings, 100, 500, current price is 499. Maybe that's not the share to buy just now, unless something has happened recently. Safaricom of Kenya announced that it's gotten a license to move into Ethiopia. Now, even though it's been 500 shillings in my example, I'm not saying it's 500 shillings, but work with me here. It then means that even though it's as nearly as high as it's been right now, it's probably a good idea to get in now because there's new information of potential enormous growth. So the first rule I do is check the pricing over the last 12 months and see where you are. If it's been 100 and it's at 110, I don't think you can go wrong jumping into it now. I hope that makes sense. The
Yeah.
second thing you do is that you look at the sector that the company is in. So, for example, nowadays, investing in energy is probably a good thing. Renewable energy. So a company that is going into renewable energy might be a good idea. Whereas a company that's in
Oil.
oil and so on might not be such a good idea because the future looks like it's going towards renewable energy. So basically, you try and anticipate where growth will come from because growth or value is what you're investing in, is what will provide you with that capital growth we looked at. But also look at the management and the board of the company that you're considering investing in. So, if, for example, the board or management are always in newspapers fighting with chairs, that's
Yeah.
probably not a company you should invest in. But if they are corporate, they seem to know what they are talking about, they give a lot of confidence to the market whenever they introduce new products, that's also a sign of a good investment. But like I said, it doesn't hurt to speak with a financial advisor who does this for a living. And as long as you've invested in some knowledge, because they're also not saints, some of them have been, have misled people. So a financial advisor is good, but go to them armed with information. I don't use financial advisors. I know they don't like me for that, but it's because I, over time, have picked up what I need to look out for. That may not be the case for everyone listening to us today.
Okay. Makes sense. Um, so I can see John has asked a question. Many thanks for your time. With regards to shares or stock selection, is it best to invest more for capital gains or dividends in the long term, or a mixture of both?
It depends on your age group. If you're younger, you should invest for capital growth. If you're older and nearing your retirement and so on, investing for income makes a lot of sense. So again, it depends on what it is you are looking for. The three reasons for investing never change, for income, for growth, capital growth, or for security. But your circumstances could change, and therefore you use that to decide what to do. I hope, John, that makes sense.
Yes, it does. I can see Eva is saying a good and simple discussion. Keep up with the work. Thanks for that, Eva. So they're saying the sound has improved. So keep at it, Sir
All right.
Tom. Um, Perfect. So just moving on to the portfolio questions. What's the ultimate balance? You have mentioned, of course, investing for income, capital gain, security. So what's the ultimate balance of investments?
All right. This is a simple guide because, again, circumstances are different for different people at different stages of their life. So don't have too much cash. We already said that about 6 months worth of expenses is a good indicator. So the rest of your investment portfolio should be roughly 30% short term, um, 30% medium term, and 30% long term. What do I mean by long term? Long term is land, property, pension. You're looking at 5, 10 years plus. The reason being that even 10 years from now, believe it or not, you will need an income and you may not be in employment. Your balance sheet becomes your employer. So you need, I mean, if ants, as small as they are, keep something for a rainy day, this is a good lesson for us humans to emulate. In terms of medium term, I'm thinking shares. I'm thinking these are listed. I'm thinking unlisted shares, maybe on startups. At the moment, fintechs, insurtechs, techie companies that are starting up are probably a good area to invest some money in. Leave the money in there for a long time because you don't know when they will strike gold, but they will. And it's probably important to say at this juncture that most of the world's highly valued companies at the moment did not exist 15 years ago. Imagine that. So I believe that story will continue. So there is a company that hasn't started today that will be valued for a lot of dollars in a few years. So try and identify fintechs, techie companies, startups, and that would fall in the medium term. Short term is T bills, money markets, bonds, as we mentioned earlier on. Remember, unit trusts also, imitate uh, short term, medium term, and long term because you have over and above the money market that's you will have bonds units and you will have equity share uh, unit trusts. So you can invest in this to emulate that spectrum I have spoken about. But land, a plot of land, an apartment, building, those are also long-term investments that, especially in Africa, developing countries, are really, really worth considering as your income increases.
So I've actually, when you were talking about those long-term investments, a question came to mind that it would be interesting to get your point of view. So there are some people who don't believe in buying the house to live in first. They believe in buying an investment apartment first, for example, or investment flat, and then they use that income to pay their own rent. What's your thought on that? Should one first buy the they're living in or an investment if it was an either or situation?
Unfortunately, it's not an either or. It's not that easy in the sense that if you're a sophisticated investor, and you know where to put your money to earn more than the rent you are paying, then it might make sense to me to continue renting and but investing the spare cash in these other vehicles. However, let's not forget most investors work during the day. They have a day job. So to beat inflation, and we all know that we prefer to live in in a house or in an apartment, not out there. So you will always need a roof over your head. I think buying when you can. If you're in a country where mortgages compare with rent, then that earlier argument goes out the window, doesn't it? Because it's costing you the same. So my school of thought, because everyone has a leaning, I lean towards owning the house you live in. You can't do that in your first 10 years of working, maybe, but you are making a landlord somewhere rich if you continue paying rent uh, uh, throughout your lifetime. And there are people who pay rent well into their 40s, 50s, and 60s. I let's just not say what I think about them.
Okay. So I'm seeing Winnie. Thanks for that, by the way, Satom. I'm seeing Winnie saying great investment tips. Thanks, Winnie. Shalom saying is asking a question. How should a guy do between 25 to 30 in order to accumulate wealth and capital despite expenses being high? So it kind of relates to the first category where we covered about how stable should one be before investing.
Yeah, I think what I would say to Shalom is that investment is not what you do after you have met your expenses. You set aside what you need to invest, what you must invest. We talked about 10% initially, uh, growing to 20 and so on. Because to be honest, you need to be investing through your earning life. That's how you stand a chance of accumulating enough. Put it this way, and we will probably talk about pension shortly.
Mhm.
Putting aside 2,000 shillings a month in your 20s is probably equivalent to putting 10,000 shillings per month in your 30s. You accumulate to the same amount in your 60s. Does that make sense? Just see I mean, I obviously haven't calculated, but it's as profound as that. Putting aside 2,000 shillings a month for 40 years is probably equivalent to putting aside 30,000, 10,000 shillings a month for 25 years. Do the math. So you don't have to put aside a lot initially, but you need to set aside something. It's the law of compound interest. It's phenomenal, and a lot of young people don't make use of that.
I
In
think that. Mhm. Sorry,
There's
go
a
ahead.
scenario here in Kenya where the laws allow an employee to access their pension when they are changing employment. I mean, how dumb can one be? Because when can you make money? When you're in your 30s or when you're in your 70s? Who needs that little money? Is it you now, or is it your version later in your 70s? But people realize this way too late, which is why this discussion is perhaps quite useful
Very.
and timely to a lot of the young people.
Yeah. So I think this is a good time to move on to the pension aspect. Of course, anything that we've left out, we can cover as we go along. So I think you've hinted at your school of thought, what you think about pensions. But if you could just probably share more points on that as to why it's important for us young people to start contributing towards our pension.
So I have had a lot of arguments against pension that one,
Yeah.
oh, I can invest that money better and get a higher return. Two, oh, I'm only 25, I will not retire for another whatever
Yeah.
time it is. And you forget that every 70-year-old you have come across was once 25 years old. I'm yet to come across an individual that skipped their 20s and went straight to their 40s and 50s. So listen to us who are older than you. It doesn't mean that you shouldn't invest elsewhere. And this is what an investment portfolio is all about. Um, Whatever you are investing in, set something aside for your sunset years because that time is coming. That's the time when your body isn't as strong as you are now. You won't get, ready medical schemes or medical insurance at that time. So you need every cash that you can get. So I would set something aside. If you're employed, you already have no excuse because most employers have a pension scheme, but some don't. Even where they don't, most insurance companies have what is called personal pension scheme, PP, whatever it is. Sets, contribute to that because even as you continue investing in other areas, you need the power of compound interest to accumulate a sizable pension. In the olden days, Belinda, uh, parents would depend on their kids to look after them in their later age. I mean, you are out in the UK. How would you help me here in Nairobi, as an example? So people need to set aside their own kite for later in life. That's my view on pension. You don't invest in pension as the best investment. It's because the purpose it's serving is a security purpose. You don't take out a life insurance policy because it has the best return in town. No, you do that for security. I don't care what the return is on the investment you're thinking about. It's not insurance. There's, it's Put
Mm.
it this way. If you started a life cover and you had only paid a year's worth of premiums and you had an accident, you will get a huge sum paid. No investment can give you that. So you're not taking out a pension, you're not taking out insurance for the return. You're doing that for the third purpose of an investment, which is security of the future.
Okay, so it's fair to say, under the category of investing for security, pension should definitely, of course, from your perspective, pension should be included, and also life policies, if you have dependents, or beneficiaries who would benefit from that. Thank you so much for that. I can see Sarah Kimani, who has said very true about the compounded interest when you start early. An option that is great in the States is the Roth IRA that enables one to still contribute on your there's something missing there when you're at the job without a 401k. Okay.
I agree. Yeah.
Mm-hmm. Perfect. Thank you for that. So just on, we're coming towards the end of our session, but just checking if there's anything that I haven't covered. So you did mention about the ultimate balance, which you should have short, medium, and long-term investment vehicles, and also investing for income, capital growth, and security. Over your investment experience, the last many decades, what has been your preferred investment vehicle? Of the many vehicles that you have, which one has been your preferred and why?
Um, in my circumstance, I have been working full time most of my life. What that means is that I did not have a lot of time to be actively involved in my investments. So I tended to favor passive investments. So that means buying land, waiting for rate to appreciate, and disposing it off when it appreciates to the level that I was looking for. One of the things that I would like to say as a tip, because most people don't do this, is when you buy an investment, determine beforehand, and this works for shares as well, determine beforehand what sort of capital gain you're looking for, 25%, 50%, whatever it is, so that when the market price gets to that point, it's not difficult to sell off. A lot of people have invested in shares, they have appreciated in value, and they have been smiling and so on, but then they don't dispose, and then the values go back down. So I tend to overcome that by determining upfront what sort of return I'm looking for. So I have favored land. I am a big land investor, but I am also big on the stock exchange. The stock exchange requires a bit more knowledge, a bit more practice than land. So I would encourage people that are starting out to consider land more than equities. But you can't have all your eggs in one basket. So I'm just saying proportionately.
Yeah.
So I have also tended to invest in startups. Someone starting, if a young person has an idea they are passionate about, that lights up their face when they are talking about it, that's usually some of what I look out for. I can give them some little money, they go and do their thing, and then in a year or two, I'm surprised by a nice hefty return. So land has been my favorite, and stocks, equities. Has- But that has been because of the nature of my job. I have been working most of my life. Nowadays, I tend to do a lot more investments that include almost daily or monthly reviews, because I now have the time.
Yeah. Thank you so much for that. I'll just go through some of the questions just to see if I've left anyone's question out. I think we haven't covered this question by CC. How can one balance between black tax and investing? So by black tax, assuming they mean that you know how Africans especially there's this expectation to support your family. So it could be your relatives, your parents, who, as you mentioned, there's usually that expectation, especially in certain generations, that you support, that the children support the parents. So how does one? She's looking for tips between what balance. How do you balance between black tax and investing?
It's a great question, Mosiara. One, I used to feel very guilty when I started working, and I didn't meet the expectation of a lot of my family members. Where uh, if they needed money to do anything, some of them were audacious enough to budget on my income. And so, but as I worked and I grew older, I realized that you really have, beyond looking after your parents, um, and by looking after your parents, I mean their needs, not wants, because you have no obligation to meet your parents' wants. But I mean, it would be embarrassing even in the West if you have an ailing parent and they are unable to go to hospital and you do nothing about. So beyond looking after your parents' needs, you really have no obligation whatsoever, and you should sleep soundly even if you don't meet other siblings or other relatives' needs, if you don't want to. So I'm differentiating between obligation and choice. You can choose to help, and that's wonderful. Maybe their prayers will increase your salary or something, I'm not sure. However, you have zero obligation beyond meeting your parents' needs. So I think you need to look after yourself and your future first before you invest heavily in your extended family. They will be good at making you feel guilty, but you know, take it from me. I don't think you should break your back to support some lazy bums just because you share DNA.
Well said. Thank you so much for that. Um, yeah, so yeah, Shalom has said that you've responded very well and they'll start doing that. So I think we can now start winding down. I can see Belinda, not sure you saw. I think it's the question we've just covered now. Thank you for that, Janice. Oh, she's saying sorry, Musiara. So we've just addressed it. Thanks for that.
Okay.
Sarah rectified something she had typed, retirement. So I think we've covered everyone's question. So just to conclude, um, what are three mistakes that you have made in your investment journey that if you had a chance now to go back, you would not do them? You'd rectify them.
So, in my generation, we feared mortgages. We grew up hearing our parents talking against loans from banks. So, I think I missed quite a few opportunities. Property I would have bought because it took me a long while to accept taking out a mortgage. Actually, at the moment, I have no mortgage, and it's probably not optimal because, again, that fear that was inbuilt in me when I was growing up was still there. And it didn't help that my wife also did not want us to get a mortgage. So I was happy when I gathered enough courage to overrule her. Um, Two, there are chances I would have taken earlier, and maybe this is an area I haven't covered, Belinda, that the younger you are, the more risk you can take. I took some risks unknowingly, but I could have taken a few more risks when I was younger, because then you have more time to correct the ship, as it were. um, and you should take less risk as you age, because then you don't have much time to correct the ship or to steady the ship later on. So there are some investments that I passed over. So take a simple thing, and this might make sense to our viewers from Africa. When you join a SACCO, a savings and what does SACCO stand for? Or whatever. Savings and credit. I used to
Commi-
know what a SACCO stood for. Um, you can either make contributions
Mhm.
or you can buy shares. Now, contributions, you get an interest return, usually in Kenya about 8, 10, 12% if you're lucky. But on shares, you get dividends at rates of initially you could go up to 30, and but it's often higher than for contributions on the basis that you have higher stake. I mean, it's higher risk because it's a share. You can't. I mean, the SACCO can't buy the shares from you. You would probably have to get a buyer. Whereas the SACCO is obligated to give you back your contributions if you within the notice that the, the rules apply. So if you have been contributing to your SACCO for 10 years and you have not bought shares, you have denied yourself significant income differential. So such little things that one would have done earlier. Another mistake, I I did not start investing overseas until much later, because diversification should also be geographical. There was a time, for a long time, 100% of my investment portfolio was in Kenya. I don't think that nowadays, with the ease at which you can invest overseas, I don't think that should be the case, especially because there are investment opportunities like in electric cars and so on that you get overseas that you don't get here. So I would say not starting early enough, not taking higher risks when I was younger, not stupid risks, higher risks when I was younger. I would say those are the when I started out, and this is not, I have nothing against Price Waterhouse. I am a very strong supporter of Price Waterhouse as an alumnus, but we did not have a pension scheme. They used to claim that our salary was all inclusive. So for my first 10 years of working, I did not have a pension scheme. I really hope and wish that that does not happen to anyone in this discussion today. Because 2,000 shillings, even 1,000 shillings a month, every month for 40 years, you will have a comfortable retirement time. I
Mm.
had to set aside a lot more later to catch up, which I did, luckily, thank God. But you don't have to wait until you have to put up a lot more per month to have a decent retirement period. So if our viewers get anything from me today, it is start as early as possible, invest for income, invest for capital growth, invest for security.
Thank you so much. That's three. It's usually said that if you want people to remember what you said, say it in, break it down to 3 points. So that's a good way to
I didn't
summarize
even know
it.
that. Mm,
Yeah. I can see some more comments have come up, but we will conclude soon just because I know in Kenya it's around, is it 9 o'clock now? But we'll just go through this quickly.
mm.
Satom, knowing what you know now, what key investments that you have made now that perhaps in hindsight you would have, or so we've literally just covered that now. Thanks, John, for that. Um, Adrienne is saying such a great answer on the black tax issue and such an informative discussion. Yeah, I know people appreciate your honesty because you know how sensitive that topic is. Most people don't usually want to say the truth about it, but as you've had, don't feel obligated to, cater to more than your parents'
Yes.
needs if you
Look
choose.
after your parents' needs. Otherwise,
Yeah.
it's even in the Bible and Quran and whatever else. We need to look after our parents. Beyond their needs, sleep soundly.
Thanks for that. Priska is saying very informative session. Thank you, Lucilla. Quite the eye-opening discussion, especially for the YOLO generation, so the young people. And Sarah is saying fear of debt. I had to overcome that culture which is prevalent in Kenya versus in the US, where credit or debt is normalized. Yeah. So definitely, as you said, start early and take risks, higher risks, not stupid risks, as Satom said very well. Yeah, so I think we can now come to a close. Thank you so much, Satom, for your time. If you'd like to hear more about his wisdom and nuggets that he shares his tips daily on his LinkedIn, maybe Satom, you can give more details on that.
Yes, my LinkedIn name is Tom Gitogo. It's not daily, it's more like weekly, but sometimes it's daily. And I do that for free. I have gone through most of these things. So I speak from my heart and I speak from experience. And I wish that people can chart a comfortable path forward. I mean, what use is what I know if I don't share it with people who might find it useful? And there you go. Tom Getogo, LinkedIn.
Yes, so definitely follow him and don't forget to subscribe to my channel as well. Hopefully, we'll see if we can bring you back for a third session. We'll see what to talk about next time. But I really appreciate you taking your time out today. So, just wishing everyone a good evening, a good night, depending on your location, and we'll speak next time.
Before you go, Belinda, you know, when you were younger, I did not find, you know, I didn't think it was good to let you know how proud I am of you. For our viewers, Belinda is my firstborn. She's named after my mother. I'm very proud of her. We are proud of what you do, if I speak for the various viewers. And we hope that your channel gains traction. You're doing good for society. And yeah, show them how it's done out there in the UK.
Thank you so much.
I'm,
Thanks,
I'm
Dad.
proud of you. I'm proud of you.
Thank you. Thanks, everyone. Bye.